Hi, I'm Jack Mohr, Research Director of Action Alerts Plus. I'm here with Portfolio Manager Jim Cramer. Now, we have a financial position, Bank of America, which had fallen out of favor, yet it reported incredibly strong earnings. What we were just talking about, it's cutting costs, it's reducing risk, yet it's driving growth. That is the trifecta. That's the holy grail of financials. Now, you love this name. How are they doing this?
All right, well, first, let's point out that the perception was that you could not own Bank of America unless rates went up. This is the most levered to rates. They have switched their profile to lower longer from the company that needs that. One of the things that they've done that is rather remarkable is that in their so-called trading line, their fixed income line, they have all this internal loan business that they do that has made it so that their trading, which is very, by the way, more than 60% of their business, as opposed to JP Morgan, which didn't do well in this business, is very risk averse. These are internal loans that they're doing, and you know, a lot of people feel like, well, wait a second, are they being cowboys, proprietary trading? No, it's just good, consistent business. That's why they're not concerned that it's so high in terms of their amount of profit. The mobile is taking over. That's enabling them to close branches. Legal fees coming down dramatically as we get out of needing the wartime consigliere of Gary Lynch, who is a terrific lawyer, general counsel, who'll be staying on overseeing a big department. But so you have expenses coming down, legal expenses, principally the outside counsel, which is just an untamed expense, is so high. Without that outside counsel line, you're going to see some gross margin expansion. Total book, true book value here, $15.50. The company will buy every share it can, and when they get through this CCAR, through the government regulation period, I think you're going to see an $18 stock rather quickly.
Yeah, and it's incredible how they've turned around so quickly. I mean, 6 months ago, they were the most hated by the regulators. Right. Now they're turning into a business that is safe, stable, and profitable. And I think that that's going to really be an inflection in the story. I mean, look, last year at this time, you had $6 billion in one quarter in legal costs. Now you had $230 million. Their loans past 60 days due, the delinquent loans have been cut in half over the last year. I mean, you look at that, and then you see expenses coming down 31% year over year. I mean, these are real, incredible value that they're driving, and they're also driving growth. I think that what Moynihan has done is nothing short of exceptional.
Yeah, and this was the breakout quarter. Now, be aware, in 2010, the stock was at 18. That's why I came up with an $18 target. It is so far behind the group that it's ridiculous. If you do get a rate hike, then you're going to see numbers here that are just astounding. But even without it, you're seeing really great growth. So I agree. I mean, this has gone from worst to first. This has become, and I love Wells Fargo, and they're doing a terrific job. Bank of America is more attractive.
Yep, and all U.S. That's something else,
exactly
forget. Thanks, Jim.